welcome to our show on financial literacy. Our topic today is personal debt. In Kenya today, we have a crisis. A lot of people are in distress. I mean, the social media, our traditional media is awash with stories of people who are in distress because of personal debt. In one of the local dailies in January, they published information to the effect that as at end of 2018, unpaid home loans, the value of unpaid home loans had hit 38.1 billion. This is a crisis, and it's about time we had this conversation. A personal debt is money owed by an individual as opposed to a business or a government. And usually there's an agreed time frame within which that money should be paid. And usually because it's a loan comes at a cost. And that cost is what is called interest. And there are different types of interest. Some interests are simple. So for example, you take a loan and you're told you're going to repay that loan at an interest of 10% per annum. Some other loans, the interest is on a reducing balance, so the interest is calculated based on the outstanding balance of the loan. In some cases, the interest will vary over the tenure of the loan. The tenure of the loan being the duration within which you need to repay the loan. Some loans are short-term, in fact, as short as a day. Some people take a loan which they want to restock their business. And so they take a loan in the morning and they're going to repay it in the evening after selling their stock. Some loans are repayable within, in the medium term, like in 6 months, 1 year. And some loans are long term, like mortgage loans. They're repayable within 15 years, even as much as 20 years. And so one of the key things that a borrower should consider when they are taking out a loan is the cost of that loan. Before you click that button to agree to the terms of the loan, before you sign on that form, if you're taking the traditional loan to basically sign up for the loan, you need to understand what it's going to cost you to basically be able to repay that loan. And that's where the interest comes in. A lot of people don't understand this concept of interest. In fact, in a survey, in a 2019 financial access survey conducted by the Central Bank and the Financial Sector Deepening Trust, they asked the respondents to calculate what the cost of 10% on a 10,000 loan would be. And that 9% of the respondents were unable to do that computation. And this is a very important issue because before you sign up for that loan, you need to understand what it's going to cost you. And you need to be able to project the repayments and determine whether you're going to be able to make the repayments on time and in the required amount. Now, let's say, for example, you've been given a loan and that loan is attracting an interest of 5% per month. For you to get a perspective of the cost of that loan, you need to annualize that rate. So take that 5% per month and multiply it by 12. And you'll be able to see immediately that the annual interest rate of that loan is 60%. And so before you sign, you need to determine whether that interest rate is reasonable. And how do you determine whether it's reasonable? Compare with the rate from other lenders in the market. Also, evaluate the cost of the loan based on the purpose for which you're taking the loan. If you're taking the loan to invest in your business, do you project making returns from that loan that are going to cover the principal and the interest and leave you with a margin? Today in Kenya, there's a very big gap between the interest that financial institutions pay on depositors' money and what they charge as interest to borrowers. In fact, in one case, there's a lender who charges, who gives a rate of between 3 to 6% on depositors' funds, while charging an interest rate of about 7.5% per month. I mean, when you look at that, it translates to about 90% on borrower's money on interest for the borrower. And that's a really huge gap. I mean, you compare 3 to 6% and 90% per annum. And so borrowers need to understand what it is costing them to borrow before committing to a loan, whether that loan is from a traditional financial institution like a bank or a SACCO, or whether that loan is from a digital lender. Having said that, is personal debt good or is it bad? I think we need to examine the purposes for which people take personal loans in order to be able to determine which types of personal debts are good and which ones are bad. So for example, you're a student and you need to pursue higher education, but your parents do not have money to pay for your higher education. And so you apply to the Higher Education Loans Board for a loan. Is that a good or a bad debt? In my view, I think that is a good debt. And why is it a good debt? Because you are investing in yourself, you're investing in skills that are going to open doors for you, new opportunities. And the terms are also usually friendly for, from the Higher Education Loans Board, because you have a grace period to repay, and then the interest rate is also low. And that money, for Higher Education Loans Board goes to a revolving fund where other students can also get. So it's important when you take that kind of loan, please do not default, pay. So that is one example of a good type of personal debt. Another example is a loan taken to buy a house, a mortgage basically. But is every mortgage a good debt? It depends. What is the value of that mortgage? If the value of that mortgage is within 30% of your income, then we can say that that is a good debt, because in all likelihood, that is the amount of money you would be spending in paying for rent. And therefore, you can substitute rent payment to home ownership. And you take a mortgage whose repayment is generally equivalent to what you'll be paying for rent. And that would constitute a good debt. But what if you take a mortgage whose repayment is so high that it's taking about 60% of your income? Obviously, it's going to strain your other expenses, and therefore that becomes a bad debt. So you need to be able to evaluate what percentage of your income is a debt going to take, and for what purpose are you going to use that loan. Let's take another example. Say you want to take a loan to buy a car. Is that a good or a bad debt? We know that a car is a depreciating asset. The value will decline with time. And therefore, if you take a loan to buy a personal car, which you use, most people actually use their car to go to work, and you'll find that only one person is in that car, at any given time. And the car is depreciating, but you still have to pay for repay the loan, principal and interest. Is that a good or bad debt? I think because the asset is depreciating, in my view, that is not a good debt. It is a bad debt. You take a loan for home improvement. You want to buy a new set of sofa set. You just passed through this furniture house. You saw this very nice set of furniture, and you thought, wow. Just the other day, I got a message from one of the lenders saying, I qualify for this X amount of loan. Then you think, why can't I just take the loan and go and buy that new set of sofa set? Is that a good idea? I don't think so. Because that, again, is a depreciating asset, and it's not going to earn you any income that you can use to repay the loan. And also, do not take a loan just because you qualify for it. Yeah? Just because you qualify for it. You need to have a proper plan of how you're going to use that money in a way that generates income that is able to help you to repay that loan. So we've been talking about personal debt, the importance of understanding the cost of a loan before you put your signature or you click to agree to taking the loan. Understand what it's going to cost you, how much interest you're going to repay, and have a plan for repayment. Determine whether the purpose for which you're going to put the loan is going to generate sufficient returns to be able to repay that loan and leave you with a surplus so that you can have a comfortable repayment. I've been your host, Lydiah Angopa. Stay tuned for our next episode of Financial Literacy.